China has ordered its airlines to stop taking deliveries of new Boeing aircraft and related parts. This came as multiple international outlets reported a Boeing jet meant for China's Xiamen Airlines had turned around and returned to King County International Airport. So we went there to confirm if the story held up. Chinese buyers are turning away from new Boeing jets because of trade penalties. Boeing has confirmed that $1 billion in value has just slipped away from the U.S. economy, putting over 1.6 million American jobs on the line. What's actually unfolding on the global economic battlefield in 2025, when China rejected a third Boeing 737 MAX, part of a deal valued at $1 billion, and sent it back to Seattle, the impact went far beyond a failed shipment. That moment marked one of the most painful freefalls in Boeing's history. Its stock wavered, the supply chain trembled, and countless American families found themselves facing possible unemployment. While Boeing scrambled, Airbus stepped in quickly, picking up fresh orders, and China's Comac jumped at the chance to expand. Suddenly, the U.S. aviation industry found itself at a make-or-break point. Is this just a single failed deal, or proof that America is slowly cutting itself off from the global economy? The answer could shape the fate of 1.6 million jobs and the very future of U.S. aerospace leadership. Find out more in today's video, and if you're new here, hit subscribe and turn on notifications so you don't miss future updates from Deep State. The third shipment of brand new Boeing 737 MAX aircraft, worth close to $1 billion, was recently returned to the U.S. by China. This marks the largest cancellation Boeing has seen since its safety scandal. The loss hit not only revenue, but also the massive U.S. supply chain, which includes workers at Spirit AeroSystems in Wichita and engineers in Renton. Officially, China blamed late deliveries, but beneath that reason lies a deeper issue: trade tariffs and rising political tension. When President Trump raised tariffs on Chinese imports to 145% earlier this April, Beijing hit back with a 125% tariff on U.S. aircraft. These sky-high taxes made it financially impossible for Chinese airlines to accept Boeing planes, even though domestic demand for flights remains strong. For Boeing, this isn't a temporary problem. China once made up 25% of its commercial revenue. Now that's fallen to just 10%, and it's still dropping. Boeing's position as the world's second-largest plane maker is now hanging by a thread. The America First policy has backfired. Instead of protecting U.S. manufacturing, it pushed away its biggest Asian client. Meanwhile, Airbus quickly struck a deal for its A320neo to replace Boeing orders. Today, more than 130 fuselages marked with logos like Air China and China Eastern are sitting idle at storage yards in Seattle and Moses Lake. They're baking under the sun, their fate uncertain. According to Liam News, each fuselage was built specifically for China. To sell them elsewhere, like India or Latin America, Boeing must overhaul the interiors, change the control systems, upgrade entertainment features, and repaint each frame. These refits are expensive, estimated at $10 to $12 million per jet, and will take at least 2 years due to part shortages and recertification needs. The financial burden keeps growing. Boeing recently admitted that it's considering selling dozens of these tariff-impacted 737 MAX jets at a major discount just to keep money flowing and avoid a new backlog disaster like the one in 2019. Each aircraft stuck in storage adds hundreds of thousands of dollars in maintenance, interest, and upkeep costs. Analysts now project that Boeing's China-related losses in 2025 could top $1.2 billion. While Boeing struggles, Airbus keeps gaining. It's expanding production lines for the A320 in Tianjin. And Comac, China's fast-rising aerospace company, is stepping up its presence. The C919, though still powered by LEAP engines from the GE Safran joint venture, now has over 1,000 orders. Comac has just opened a larger assembly line targeting production of 150 jets per year. If things continue this way, Airbus, Comac, and Embraer could carve up the global market Boeing once led. That canceled $1 billion deal wasn't just a random setback, it was a harsh reality check for the U.S. government's trade tactics. When China closes its doors, Boeing loses its market. Airbus grabs the orders, Comac climbs higher, and the U.S. aerospace industry loses ground. Can America maintain its leadership in aviation when its own policies are driving away customers? That question echoes across those grounded fuselages in Seattle. and in the halls of the White House, where new tariff decisions could either save or shatter what's left of the U.S. aircraft advantage. Just 3 weeks after Boeing's $1 billion setback, Airbus quietly swooped in. Instead of making noise, the European company signed deal after deal. In 2022, Airbus secured a historic 292-jet agreement worth nearly $37 billion with 3 Chinese state airlines. By September 2024, it added 80 A320neos through leasing deals. Then came 40 Comac rival C919S for Tibet Airlines in Q1 2024 alone. That brings over 420 new aircraft committed to Airbus, pushing its market share in China to more than 55%, making it the top foreign aircraft provider in a country that used to be Boeing's second home. And the dominance isn't just in deals. During French President Emmanuel Macron's 2023 visit to Beijing, Airbus signed an agreement to open a second A320neo production line in Tianjin. This will double capacity to 12 jets per month by 2026 and promise deliveries in under 2 years. Meanwhile, Boeing is stuck reworking 130 jets in Seattle, jets that were supposed to be flying in China today. Comac is also pushing forward. Under its January 2025 roadmap, C919 production is expected to hit 50 aircraft this year. It plans to ramp up to 75 per year within 4 years, aiming to reach 150 to 200 annually before 2030. Analysts point out that the C919 is priced around 10 to 20% lower than the A320neo and 737 MAX. This pricing gives China a clear edge, especially when tariffs act like a direct weapon against Boeing. But China's plans don't stop at home. Comac is expanding into Southeast Asia. In March 2025, Vietnam's Civil Aviation Authority proposed certifying Chinese planes so that Vietjet could start flying the C919 by 2026. Meanwhile, Lion Air and Garuda Indonesia were invited to test the jet during the Singapore Air Show. Comac also offers sweeteners like low-interest financing and free pilot training, undercutting both Boeing and Airbus by lowering operational costs. Airbus currently controls over half of the market, and Comac is rapidly catching up. Meanwhile, Boeing is getting squeezed from both sides. Trump-era tariffs have pushed its prices up, while its competitors are slashing costs and delivering faster. At one point, China accounted for 25% of Boeing's commercial revenue. Today, that opportunity is fading. Airbus has gained an edge by assembling planes locally, and Comac aims to grab 10% of the global narrow-body market by 2030. If this trend spreads across ASEAN, the world's fastest-growing aviation market, Boeing's long-term future may be at risk. But behind the numbers lies something bigger, a mix of industrial and political strategy. Europe is building influence through products, China is chasing self-reliance, and the U.S. is isolating itself with tariffs. In the next part, we'll dive into how pricing, technology, and diplomacy are helping Airbus and Comac push Boeing out of the skies over Asia.